Welcome. My name is Marcy Hampton, and I'm a faculty member at the UCF Dixon School of Accounting. In this short lecture, I am going to talk about MACRS depreciation. This video is video 1 of 3 videos on MACRS depreciation. This video will deal with general details about MACRS as well as MACRS for real property. Let's start with what is MACRS. MACRS stands for Modified Accelerated Cost Recovery System. It is a modification of the previous system, ACRS or ACRS. MACRS is the current depreciation system that we use for tax purposes for property placed in service after 1986. The method that it uses depends on whether the property being depreciated is tangible personal property or real property. So let's do a comparison of how we calculate MACRS, what we need to calculate MACRS depreciation versus what we need to calculate GAAP depreciation. So the first thing that we need to calculate GAAP depreciation is the cost. Same for MACRS. The next thing that we need to calculate GAAP depreciation is the estimated useful life. For MACRS, however, we have preset classes that all assets fit into, so we narrow down the possibilities of different estimated useful lives. The next thing that we need in order to calculate depreciation for GAAP purposes is the date placed in service, so that we can calculate the partial year based on the number of days it was actually used during the year. For MACRS, we actually have preset conventions in order to do the partial year that will determine how much we will depreciate for the partial year in the beginning and at the end. The last thing we have to do for GAAP depreciation is choose the method to use. Are we going to use straight line? Are we going to use sum of the year's digits? Are we going to use double declining balance? For MACRS, it's already preset for us. By doing this, we can then create tables that everybody can use to calculate depreciation, thereby making it much easier for taxpayers to calculate depreciation for tax purposes. So one issue that we sometimes have is when we have personal use property that we're converting to business use. The problem being, what is the basis going to be for the personal use asset now once it's converted to business use? The basis is going to be the lower of the actual adjusted basis or the fair market value at the time of the conversion. We do this so that you can't convert a non-deductible personal loss into a deductible business loss just by bringing it into business use. Remember, personal use losses are not deductible. For example, if our asset has an adjusted basis of $10,000 and the fair market value on the date of conversion to business use property is $6,000, we can't bring it in with a basis of $10,000 and then immediately sell it for $6,000 and thereby enable ourselves to deduct a $4,000 loss that we would not have been able to deduct if we kept it a personal use asset. So how do we actually calculate MACRS for real property? The method that it uses is straight line. The classes that we have to choose from are either residential, which is going to be depreciated over 27.5 years, or non-residential, which is going to be depreciated over 39 years. The convention that we're going to use is what we call the mid-month convention. In this convention, regardless of when during the month the building is placed in service, we're going to treat it as if it was placed in service halfway through the month. Therefore, we're going to get half a month's depreciation in the first month and half a month's depreciation in the last month. So how do we actually calculate depreciation for real property? First thing we're going to do is determine if it's real property or tangible personal property. If it's real property, we're going to determine if it is residential or non-residential. That will tell us what appropriate table to go to within the real property tables, residential or non-residential. Once we get to the appropriate table, you're going to go to the column for the month in the tax year that it was placed in service. Then go to the year of recovery. Then take the rate from the table for the month it was placed in service and the year of recovery, and multiply that rate times the basis of the property. So how do we calculate the MACRS depreciation for real property in the year of disposal? If the property is disposed of before the final year of the table, you will actually have to manually calculate the partial year depreciation for the asset in the final year. Remember that the partial year depreciation is automatically built in the beginning and the end of the tables. But if you sell it and dispose of it in a year other than the end year of the table, you will have to manually calculate the partial year. So first thing we'll do is follow the steps that we did just a minute ago to calculate the full year's depreciation. We would go to the right column and the right recovery year and get the rate, calculating the full year's depreciation. We would then take the full year's depreciation amount and multiply it times the number of months used in the final year. Remember that we can only use half of the final month used due to the mid-month convention. So let's do an example of how we calculate MACRS depreciation for real property. If a company acquires a warehouse for $200,000 on May 1st of 2014, what is the depreciation for the first year? Well, we say it's non-residential real property, so we use that table. It was placed in service in the 5th month, so we use that column. So we go to the table and we go to the 5th month and we look at the rate from the table for the first year and the 5th month, and that is 1.605%. So the depreciation for the first year would be $200,000 basis times 1.605%, or a total of $3,210 depreciation. Just so you know, the 1.605% comes from taking 100%, dividing it by the number of years we're going to depreciate it over, in this case 39 years, and multiplying it times 7.5%, 7.5 out of 12 months based on the mid-month convention. Continuing this example, if the company sells the building on October 1st of 15, then what we need to do is take the rate for the second year in the 5th month. Remember, we never change columns. We place it in service in the 5th month. We went to the column that had the 5th month. We stay in that column throughout its entire life. The rate for the second year in the 5th month is 2.564%. We're going to then multiply the $200,000 basis times the 2.564% for full year's depreciation. Since it was sold, we're only entitled to a partial year depreciation through half of the last month that it was used. Since it was used through into the 10th month, then we're going to take the full year depreciation and we're going to multiply it times 9.5 out of 12 months. Therefore, the final year depreciation is going to be 9 full months plus half of the 10th month for 9.5 months. And that is how we do MACRS depreciation for real property.